Right now, while you're watching this, your $100 is losing value. Not tomorrow, not next year. Right now, every single hour you leave that money sitting in your checking account doing absolutely nothing, it is worth a little bit less than it was the hour before. Inflation is quietly eating it alive like termites inside a wall you cannot even see. And here is what makes this even worse. Starting with just $100 invested the right way, at your age, could turn into over $50,000 without you doing almost anything extra. But most people will never see that money because nobody ever showed them how stupidly simple it actually is to start. By the time you finish watching this, you will know exactly where to put your first $100, exactly what to buy with it, and exactly why starting today, instead of waiting even one more month, could be worth thousands of dollars to your future self. And the part that is going to blow your mind? It takes less than 15 minutes to set the whole thing up. You already know what it feels like. You get your paycheck, and for about 2 seconds you feel okay. Like you can breathe for a moment. Then the bills hit. Rent takes half of it, maybe more than half. Your car payment takes another chunk. Then there's your phone bill, your electricity, groceries that somehow cost twice what they did a couple of years ago, gas to get to work and back, maybe a student loan payment that you try not to think about because the number barely moves no matter how many payments you make. And if you're really unlucky, there's a credit card balance sitting in the background collecting interest like a quiet little vampire sucking money out of your account while you sleep. By the time all of that is done, you open your bank app and you stare at what is left. And it is almost nothing. Maybe $200, maybe $150, maybe less. And your next payday is still 10 days away. Sound familiar? You work 40 hours a week, maybe more. You're not lazy. You're not irresponsible. You're not blowing money on stupid things. You're doing everything you are supposed to do. And yet somehow, at the end of every single month, you are basically right back where you started. Then you open social media and you see people your age on vacations, buying houses, talking about their investment portfolios. And you sit there thinking, what am I doing wrong? How are they doing that? Do they have rich parents? Did they win the lottery? Is everyone lying? And the worst part is that feeling at 2 a.m. You're lying in bed and your brain starts doing math. Rent is due in 5 days. The electric bill is late. Your tire is going flat and you have no idea how you're going to pay for a new one. You just lie there staring at the ceiling doing calculations that never add up to anything good. You have probably heard people talk about investing. Maybe a coworker mentioned it. Maybe you saw something online. And every single time, it felt like a world that was not built for you. Like investing is for people who already have money. People with $10,000 sitting around. People with financial advisors and fancy accounts and business degrees. You hear words like stocks, bonds, portfolios, dividends, market cap, and it all sounds like a foreign language that nobody ever bothered to teach you. So you tell yourself you will figure it out later, when you make more money, when things are less tight, when you finally have enough to actually invest. And that later turns into weeks, then months, then years. And the whole time, the opportunity is right there in front of you, waiting, getting a little less powerful every day you ignore it. But here's the truth that nobody is telling you. You do not need thousands of dollars to start investing. You do not need a finance degree. You do not need to understand the stock market. You do not need to pick the next big company. You need $100 in about 15 minutes. That is it. And what you are about to learn right now is going to make you wish you had heard this years ago. The first thing you need to understand is this. The biggest lie about investing is that you need a lot of money to start. This is the lie that keeps regular working people out of the game. You hear about investing and you picture some guy in a suit on Wall Street screaming into a phone making million-dollar trades. You picture wealthy people sitting in fancy offices talking to their financial advisors about which yacht to buy next. And because of that picture in your head, you think, well, that is clearly not for me. I only have $100. What could $100 possibly do? And that is exactly the thought that keeps you broke. Here is the reality. $100 today is more powerful than $1,000 10 years from now. That sounds insane, right? But it is true. And here's why. When you invest money, it does not just sit there like it does in your checking account. It grows. And the earlier you put in, the more time it has to grow. Think of it like planting a tree. If you plant a tiny seed today, in 10 years you have a big tree giving you shade and fruit. If you wait 10 years to plant that same seed, you have a seed. The amount you start with matters so much less than when you start. And right now, today, you have the one thing that no amount of money can buy later. Time. 20 years ago, you actually did need a lot of money to invest. Brokers charged fees. You needed minimum deposits of $1,000 or $3,000 just to open an account. But that world is gone. Today, you can open an investment account with literally $1. No fees, no minimum, no suit required. The barriers that used to keep regular people out have been completely demolished. The door is wide open. The only thing keeping you from walking through it is not knowing that it is there. But here's where it gets really interesting. The second thing you need to understand is what investing actually is. Because most people have a completely wrong picture of it in their heads. When you hear the word investing, you probably imagine someone sitting at a desk with 6 computer monitors, watching numbers fly by in green and red, frantically buying and selling, trying to get rich quick. That is not investing. That is trading. And trading is basically gambling with a fancier name. Real investing is boring. And that is exactly why it works. Here is the simplest way to think about it. Investing means you take your money, you use it to buy a tiny little piece of a company, and then as that company makes money and grows over the years, your tiny little piece becomes worth more. That is it. That is the whole thing. Think of it like buying a slice of a pizza shop. You give the owner $100. In exchange, you own a tiny piece of that shop. You do not work there. You do not make the pizza. You do not deal with customers. You just own a little piece. And as the shop gets more popular and makes more money, your little piece becomes worth more. Maybe in 5 years, that $100 piece is now worth $150. Maybe in 20 years, it is worth $800. You did nothing. The pizza shop did all the work. Your money just sat there and grew. That is investing. You're buying tiny pieces of real businesses. When you buy what is called a stock, you're buying a little slice of a real company. Apple, Amazon, Google, Walmart. When those companies grow and make more money, your little slice grows too. You do not have to understand anything about running those companies. You just own a piece and you wait. Now you might be thinking, okay, but how do I know which company to buy? What if I pick the wrong one and lose everything? And that is a great question, because this is where most beginners mess up. And what you are about to hear next solves this problem completely. Most people think that to invest, you have to be smart enough to pick the right company. You have to find the next Amazon before it blows up. You have to research and analyze and predict. And because that sounds incredibly hard and risky, most people just do not invest at all. They freeze. But here is the secret that professional investors do not want you to know. You do not have to pick individual companies. There is something called an index fund, and it is the single greatest invention for regular, everyday people who want to invest without any stress. An index fund is dead simple. Instead of you buying one single company and praying it does well, an index fund lets you buy a tiny piece of hundreds of companies all at once, with one single purchase. So when you put your $100 into an index fund, you are not betting on one company. You are spreading your money across 500 of the biggest, most successful companies in the entire country. If one company has a bad year, the others pick up the slack. If one goes bankrupt, the other 499 are still standing. Think of it like this. Imagine you love eggs. You have 10 eggs. If you put all 10 eggs in one basket and you trip, every single egg breaks. Game over. But if you put one egg in 10 different baskets and you trip and drop one basket, you only lose one egg. You still have 9. That is what an index fund does with your money. It spreads it out so you're never destroyed by one bad pick. The most popular index fund in the world is called the S&P 500. The S&P 500 is just a list of the 500 biggest companies in America. Companies like Apple, Microsoft, Johnson & Johnson, Coca-Cola, Nike. When you invest in an S&P 500 index fund, you instantly own a tiny piece of all 500 of those companies. And over the past several decades, the S&P 500 has grown by an average of about 10% per year. Some years it goes up 20%. Some years it goes down 15%. But over the long run, year after year after year, it averages about 10% growth. That is not a guarantee of the future, but it is a very strong track record. And this next one, this is the one that almost nobody talks about, but it might be the most important one of all. Now that you know what to invest in, you need to know where to actually do it. How do you physically take your $100 and put it into an index fund? This is the part that stops most people because they think it is some complicated process with paperwork and meetings and phone calls. It is not. It is easier than ordering food delivery from your phone. You need to open what is called a brokerage account. A brokerage account is basically just a special bank account that lets you buy investments. Think of your normal bank account like a parking garage for your money. Your money just sits there parked doing nothing. A brokerage account is more like a garden. You put your money in and things actually grow. There are a bunch of free apps and websites where you can open a brokerage account in about 10 minutes. Fidelity, Charles Schwab, and Vanguard are three of the most trusted ones that have been around for decades. They charge 0 fees to open an account and 0 fees to buy index funds. You download the app, you put in your name and basic information, you connect your bank account, and you transfer your $100. That is it. Once the money is in there, you search for an S&P 500 index fund, you click buy, and you are done. You are officially an investor. The whole thing takes less time than waiting in line at a coffee shop. Now, some people also hear about something called a Roth IRA. A Roth IRA is a special type of brokerage account that has a massive tax benefit. When you invest inside a Roth IRA, your money grows, and when you take it out after you turn 59 and a half, you pay 0 taxes on everything it earned. 0. Think about that. If your $100 turns into $5,000 over the decades, you keep all $5,000. The government does not take a single penny of those gains. If you invest in a regular brokerage account, you would have to pay taxes on those gains. So if you're starting out and you have the option, opening a Roth IRA is usually the smarter move. You can open one of the same places I just mentioned. Fidelity, Schwab, Vanguard. Same easy process. But here's where it gets really interesting, because the next piece of this puzzle is what separates people who build real wealth from people who stay stuck forever. Your first $100 is important, but what is more important is what you do after that first $100. This is where the magic word comes in. Consistency. Investing $100 one time is great. It is a start, but the people who actually build real wealth are the ones who invest a little bit every single month, even when they do not feel like it, even when money is tight, even when it feels pointless. Here's why. Let us say you invest $100 every single month into an S&P 500 index fund. Just $100. That is about $3.33 a day. That is less than a coffee at most places. After 1 year, you have put in $1,200 of your own money. But because of the average 10% growth, your account is worth about $1,260. Okay, not life-changing yet, but keep going. After 5 years, you have put in $6,000 of your own money. Your account is now worth about $7,800. After 10 years, you have put in $12,000. Your account is worth about $20,500. Wait, that is $8,500 more than you actually put in. Where did that extra money come from? You did not work for it. You did not earn it. It just appeared. That extra money is your money making money. And it gets wilder. After 20 years of putting in $100 a month, you have contributed $24,000 of your own hard-earned cash. But your account is not worth $24,000. It is worth about $76,000. You made over $50,000 that you never worked a single hour for. And after 30 years, you have put in $36,000. Your account is worth roughly $226,000. Let me say that again. You invested $100 a month, which is basically the cost of eating out 4 times, and after 30 years, it turned into over $200,000. That is a house. That is retirement money. That is life-changing money. From $100 a month. What you're about to hear next is something that 95% of people will go their entire lives without ever figuring out on their own. Those giant numbers I just told you about, they are not magic. They come from something called compound interest. And compound interest is the single most powerful force in personal finance. It is the reason rich people keep getting richer. It is the reason starting early matters so much. And it is the reason your $100 today is worth more than $1,000 10 years from now. Here is how compound interest works in the simplest possible way. When you invest $100 and it grows by 10% in a year, you now have $110. Cool. But the next year, you do not just earn 10% on your original $100. You earn 10% on $110. So you earn $11 instead of $10. Now you have $121. The year after that, you earn 10% on $121. So you earn $12.10. Now you have $133.10. See what is happening? Every year, you earn money on your original money and on the money your money already earned. Your money is making money, and then that money is making money. It is like a snowball rolling down a hill. It starts small, but it picks up more snow as it goes, and it gets bigger and bigger and faster. This is why time is everything. The difference between starting at 22 and starting at 32 is not just 10 years. It is hundreds of thousands of dollars. Because those first 10 years are when the snowball is getting started. Those are the years when your money is planting the seeds for all that growth later. If you skip those years, you can never get them back. No amount of money later can replace the time you lost. Think of it like baking bread. Compound interest is the yeast. Once you mix it in and give it time, the dough rises on its own. You do not have to do anything. But if you wait 4 hours to add the yeast instead of adding it right away, that bread is never going to rise the same way. The yeast needs time to do its thing. Your money needs time to do its thing. And the best time to give it that time is right now. Not when you get a raise. Not when you pay off your student loans. Not when you feel ready. Right now, even if it is just $100. Most people stop right here, and that is exactly why they stay stuck, because the next thing I'm going to tell you changes the whole game. Let us talk about the mistakes that will destroy your investing before it even gets started. Because knowing what to do is only half the battle. You also need to know what not to do. And these mistakes are so common that almost every single beginner makes at least one of them. Mistake number 1, trying to time the market. You will hear people say things like, the market is too high right now. I will wait for it to drop. Or, the market just crashed. I am too scared to invest. Here is the truth. Nobody can predict what the market will do tomorrow, next week, or next month. Professional investors with billion-dollar teams cannot do it consistently. You definitely cannot do it from your phone while eating breakfast. The best strategy is to invest your $100 every single month, no matter what the market is doing. Some months you buy when it is high. Some months you buy when it is low. Over time, it all averages out. This is called dollar cost averaging. Fancy term, simple idea. Just buy consistently and do not try to be clever about timing. Mistake number 2, checking your account every single day. When you first start investing, you're going to want to open that app every 5 minutes to see if your money went up or down. Do not do this. The market goes up and down every single day. Some days your $100 will be worth $97. You will panic. You will think you made a horrible mistake. You will want to pull your money out. This is completely normal and completely wrong. The market drops all the time in the short term. But over the long term, over years and decades, it goes up. If you check every day, your emotions will trick you into making terrible decisions. Think of it like planting a seed and then digging it up every day to see if it has grown yet. You will kill the plant. Just plant the seed, water it occasionally, and leave it alone. Check your investments maybe once a month or once every few months. That is plenty. Mistake number 3, investing money you cannot afford to lose right now. This is crucial. Before you invest your $100, you need to make sure it is $100 you genuinely do not need for at least 5 years. If your rent is due next week and you only have $300 in your bank account, do not invest $100 of that. Investing is for money you can lock away and forget about. The market can drop 20 or 30% in a single year. It recovers over time, but if you need that money during the dip, you are forced to sell a loss. That is like being forced to sell your house during a bad market because you need the cash. You will always lose. So make sure your basic bills are covered first. Make sure you have at least a small emergency cushion. Even $500 set aside for emergencies. Then start investing with money on top of that. And this is where it gets really interesting, because this last thing I'm about to tell you is the one piece of information that ties everything together. And it is the reason most people who learn about investing still never actually do it. The biggest enemy of your financial future is not your income. It is not your bills. It is not the economy. It is not the stock market. It is not inflation. The biggest enemy is a tiny little voice inside your head that says, "What is the point? $100 is nothing. It will not make a difference. I will start when I have real money to invest." That voice is lying to you. It is the most expensive lie you will ever believe. Every single person who has ever built wealth from nothing started with an amount that felt embarrassingly small. They started with $50, with $100, with $25, and they felt exactly what you are feeling right now. They felt silly. They felt like it was pointless. They looked at their tiny little investment account and thought, this is never going to become anything. But they did it anyway, and they kept doing it, month after month, year after year. And compound interest did what compound interest does. Here is a number that is going to sit in your brain for days. If you're 25 years old right now and you start investing $100 a month today, by the time you are 65, you will have roughly $632,000. That is not counting any raises, any increases in what you invest, any bonuses, nothing. Just plain $100 a month for 40 years at 10% average returns. $632,000 from $100 a month, from the cost of 4 takeout meals. But if you wait until you are 35 to start, you will have about $226,000 by age 65. Still good, still life-changing. But that is $400,000 less than if you started at 25. $400,000 gone. Not because you did anything wrong, not because you made a bad investment, but because you listened to that little voice that told you $100 was not enough to bother with. That 10-year delay cost you $400,000. That is not a typo. That is real math. That is the real cost of waiting. Every single month you delay, you're not just losing $100. You're losing all the money that $100 would have made, and all the money that money would have made, and all the money that money would have made, stretching out over decades into a giant invisible pile of cash that you will never even know you lost. You do not need to be rich to start investing. You need to be brave enough to start before you feel ready. You need to be stubborn enough to keep going when it feels pointless. And you need to understand deeply in your gut that the $100 sitting in your bank account right now doing nothing is not just $100. It is the seed of every single dollar you will ever have. And the only thing it needs from you is permission to grow.